Hello friends, this is Professor Amarjeet Kaur, Professor of Accounting at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am here with you to talk about a very important topic, financial instrument, which is discussed under the subject financial management, where we are talking about financial system. So, financial system comprises many pillars, as we all understand, be it financial market, financial services, financial instruments, financial regulatories, etc., etc. So, financial instrument is one of the important pillar of financial system. In this direction, we had discussed financial instruments which are of primary nature, of cash nature, in the part 1 in past. And today we are going to talk about, in this part number 2 of financial instrument, we are going to talk about derivative financial instruments and foreign exchange financial instruments, two categories of financial instruments, because the first category has been discussed in the part 1. If you are interested to learn about cash instruments, which is the primary financial instrument, and if you have missed that as a live, please go ahead and search for part 1 of financial instrument. So, let us proceed with the agenda to talk about financial instrument, two aspects of it, derivatives and foreign exchange. So, friends, financial instrument, as has been narrated, is a real or a virtual legal agreement of monetary value. So, we have to have some kind of monetary value in the agreement which is legal, or it can be real or virtual, does not matter, and that instrument means, which we are taking it as a financial instrument, it can be traded or exchanged. So, it may be in an asset such as stock, bond, derivatives, or in cash itself or loans format itself, right. So, that is what the financial instruments, a real or virtual legal agreement primarily of monetary value. Okay. So, coming to financial instruments, second category, derivatives, what they are. So, derivative instruments or derivative financial instruments, they are financial instruments that derives their value from underlying asset, such as resources, currency, bonds, stock indexes, etc., etc. It means these instruments do not have their own value, they derive, that is how they have been. So, that the nomenclature derivatives means they derive value from something else, and something else is underlying asset, and that underlying asset could be currency or crop or bonds or stock or any indices itself. Okay, that is how the derivative instruments are defined. So, now the value and the characteristics of derivative instruments, they are based on the vehicle underlying components such as assets, interest rate or indices. An equity option contract such as a call option on a particular stock is a derivative because it derives its value from underlying shares. Okay, so getting the point I am making is the value and the characteristics, both what kind of characteristics that instrument will have, that will depend of that particular derivative instrument which we are talking or we are referring to. They are based on the underlying component. So, basis on the characteristics of the underlying component or underlying asset, the characteristics of financial instrument, the derivative instrument will change, right. So, if I am talking of the indices is the basis of of that derivative instrument. So, my derivative instrument would be based or affected by the index value. Interest rate, then interest rates basis the features of different interest rates will define my financial instrument. So, because these assets are the ones defining the characteristics of the derivative instrument, right. For example, the shares, if I have equity option, if my derivatives is based on the equity, so they will derive the value of the share. The shares value will define my derivatives characteristics and value both. Now, commodity derivatives are financial instruments. They include future forwards or options, either the future option is there, forward option is there, and contracts that use a commodity as the underlying asset. Other than the share, another example could be the derivative which is based on the commodity. It is not only always share, it is not only the financial asset. The commodity is not a financial asset, it is a real substance. Okay, it could be crop, it could be gold, it could be the derivatives could be the underlying asset, could be even the weather. Underlying asset nowadays are actually very hostile in nature. We can take anything as and even the event can be underlying asset. So, commodities such as precious metals, energy, product, etc., they do not typically meet the definition of financial instrument. That is why they do not confer a claim or an obligation. They are slightly different, right? Commodity derivatives are though financial instrument, but certain commodities such as precious metal, energy products, they do not typically meet the definition. Okay. So, then what else do we have in the derivative instruments? There are couple of things. So, there are 5 primarily major, in fact not primarily, major major parts or major instruments in derivative instruments I am going to discuss. One is options, another is future contracts, 3 forward contracts, number 4 swaps, number 5 synthetic agreements. I shall be discussing about them one by one. Options for option forwards, right. So, let me discuss with the, let me start with the forward. So, what is a forward contract or forward derivative instrument? So, forward is a contract between 2 parties that involves customized derivatives where exchange occurs at the end of the contract at a specific price. So, which means price is decided in advance, it is known specific price, and the exchange will happen at the end. It is a forward contract. So, forward derivatives are the ones where the exchange in real exchange will happen only at the end, at the maturity of the timeline we specified, and the price is also specified. On the other hand, the future is also a derivative, of course, a financial instrument is a financial derivative. Derivative means financial instrument. The second category, a derivative transaction that provides the exchange of derivatives on a determined future date at a predetermined exchange rate. So, here the derivative transaction that provides the exchange of derivatives on, so in future there is an exchange of derivatives is happening on a determined future date at a predetermined exchange rate. Exchange rate is decided in advance, the future date predetermined on a future date also is there. So, that is what the future is. So, third is options. What are options? Options are an agreement between 2 parties in which the seller grants the buyer the right to purchase or sell a certain number of derivatives at a predetermined price for a specific period of time. So, it means here what is happening, it is an agreement, all derivatives are agreement, and agreement between 2 parties, 2 entities. One of them is seller and another is buyer. So, what is happening here? The seller is granting the buyer the right to purchase. So, who has to exercise the right to purchase or sell? Buyer. So, buyer has a right to purchase or sell a certain number of derivatives at a predetermined price is decided in advance, and but for a particular period of time between January 1st to July 30th, right, 6 months, between this date to between this date, between this year to this year, this month to this month, or days. So, period, the span of period is decided, is specific, price is predetermined, but who is going to exercise the right in option? Who has the right in option? The buyer has the right. Okay, that is how it works. So, then the swap, we talked about swaps as well. So, in swap we have interest rate swap, or swap we can call it in any way. it involves the swapping of swapping of interest rates, where each party agrees to pay interest rates on their loans in different currencies. Here the role of currency comes into play. Let us say there are different parties, one wants to deal in dollar, another want to deal in rupees, third want to deal in taka, fourth want to deal in Swiss, any country's currency. So, or euro, whatever. So, it involves the swapping of interest rate is swapped, my interest is X amount, for example, in dollars, equivalent amount in rupees would be, so here the currency plays a role, right. So, interest rate is swapped between the different currencies. So, here each party whosoever is involved in the derivative, they agrees to pay interest rates on their loans in different currencies. That is the crux here in these kind of derivatives. Now, we have financial instrument in derivatives, there could be synthetic agreement for foreign exchange. It is an agreement that guarantees a specified exchange rate during an agreed period of time. A safe occurs in the over the counter market. So, if I talk about the another type of financial instrument, synthetic agreement for foreign exchange. So, SAFE, we call them in a short name SAFE, synthetic agreement for foreign exchange. It is an agreement that guarantees a specified exchange rate during an agreed period of time. So, period of time, your risk as an investor is up to that period which has been agreed upon. So, period is important. So, people who have very good sense of how the markets are behaving or doing, that matters a lot. So, these safes are basically generally they are traded on over the counter exchange market, OTC, over the counter exchange, then normal stock exchanges, that is a general practice. Okay. So, this was about the financial instruments which falls under the derivative categories. Now, I would like to talk about the financial instruments that fall under foreign exchange category, the third category. So, first category, as I said, was financial instrument which are the most commonly known to general people like me and you who are not specialist in. So, it was the cash instrument, which could be debt or equity, the primary instruments. The debt instruments we discussed, be it in the form of RD or loan, project term loan or project loan, or FD or saving or debenture or bonds. That is what we discussed. We talked about the equity instrument where the ownership right is given, it could be share, it could be mutual fund share part or SIP, that gives you certain kind of ownership right. And then the second category we talked about a few seconds ago, in fact few minutes ago, we talked about the instruments which are financial instrument but known as the second class of financial instrument or the second type of is what we discussed about the derivative instruments. And now I have reached to the third category of financial instruments which are known as foreign exchange instruments. So, what are foreign exchange instruments? Foreign exchange instruments, they refer to financial instruments that are represented on a foreign market, and mainly they consist of currency agreements and derivatives, right. In terms of currency agreements, they can be broken into three categories which we will discuss, but just let us discuss this first. Foreign exchange instrument, they are what exactly? They are instruments. So, instrument need not to be in hard form all the time. They are giving you some legal right for sure, right. It has some monetary value for sure. These features are mandated to be in the to be known as financial instrument, as as a bottom line. Now, they are representing the financial instrument under foreign exchange category. They are actually represented on a foreign market, and mainly they consist of currency agreements, or derivatives which are having the currency used in it. So people actually create derivatives under for the foreign currency only, and there are researchers, there are people who do not consider foreign exchange instrument as a separate category, believe me or not. They take them a foreign because these instruments are based on foreign currency, involving currency into it of different countries, but they are actually taken as derivatives only. So, in literature, in few of the books, few of the articles, you may find foreign exchange financial instrument as part of derivatives only, because so I did not discuss the foreign exchange based instruments in derivative category. I am putting it separately because most of the literature would suggest it as a separate head itself. But there is no denial that you may find certain literature where only two categories are discussed, primary and secondary. In secondary derivatives one, we find the foreign exchange instrument as well, right. So, they are basically currency agreements that I will buy, I know brokers, so I know people whom we generally buy, when we are traveling, we buy dollars or other euros, or if we are traveling to Europe. So, depending on where we are traveling to, so they actually keep on buying in advance. They bet on that, they understand this price will go up or go down for a particular currency. Accordingly, they bet for those currency agreements, which is basically instruments, and that right to them, that gives that they have ownership of their currency, particular currency, up to that extent, and they have to settle in certain days. So, settlement will depend upon the category within the foreign exchange instrument, which I am going to discuss soon. We have primarily three categories, right. But point I want to make is that these foreign exchange instruments are currency agreements. That's so, because foreign exchange means some some currency of other country is involved into it. So, there are three foreign exchange instruments: spot, outright forwards, and currency swaps. So, I will be discussing these three now in little detail, not much in detail. The first one is spot. So, what are spots? Spots are basically currency agreements in which actual exchange of currency is no later than the second working day after the original date of the agreement. If the actual working date of the agreement was, let us say, 16th of December, we are today sitting on 16th of December. So, it is not going to be no later than the second working day. If 17th happens to be Sunday, so it is a non-working day, right. If 17th happened to be Saturday, Sunday, and 18 means Sunday, so 17 and 18 both are non-working days. So, we no later than second working day. 19th may, let us say, Monday is working, and then Tuesday is working day, right. So, it is no later than Tuesday if we take it that way. So, if 16th of any month was, for example, was Friday, is no later than the second working day after the original date of agreement. Original date of agreement, so we have to see, and we have to skip the non-working days, and then in the working days we have to go to second working day, right. So, getting the point. So, it is a currency agreement in which the actual exchange of currency is no later than. So, it is the bet period is not that longer, the actual exchange, so I will buy or sell dollars, or I will buy or sell euros, whatever, I could be buyer or I could be seller, but exchange would be the, so here in the spot of exchange, the working day is important, it becomes crucial. That is otherwise, all the instruments, they would have little bit variation from each other. So, that is why I am putting emphasis on spot. So, the term spot, why it has been termed as spot? Because the currency exchange is done on the spot for limited time frame. Whatever the price on that working day would be, right, on the spot. That is why we call the spot. At that price it would be exchanged. The people do not actually exchange, they just debit or credit, they actually just settle the transaction with the difference. And you may be loser, you may be gainer here. It's kind of betting, it's kind of encashing on your understanding of the market, your knowledge about the foreign exchange currency, and everyone cannot be good in all the currencies of all the countries of the world. So, and primarily there are few currencies, as of date, worldwide, the major source of or major currency which is used for import export is dollar as of date, and the euro, and there are a couple of more currencies which are becoming stronger, of course. And there are countries which are targeting to make their currency as a accepted medium of exchange for trade. But nevertheless, as of date, when we speak today, dollar is the most commonly used currency for settlement of export and import. But the point in spot is that they are known as spot, they are named as spot because currency exchange is done on the spot, right, for a limited time period, and the days are defined in advance. That second working day becomes important here. Then we have forward, outright forward. So, what they are? A currency agreement in which the actual exchange of currency is done forwardly and before the actual date of the agreed requirement. So, it is forwardly. So, your actual exchange is happening, is done forwardly. So, that is how they are named as forward. So, it is beneficial in case of fluctuating exchange rates, and that changes often. So, when the market is actually very fluctuating and volatile, in those cases, on those times, we follow, we will adopt, or people will get into the outright forward. So, very much like the spot agreement we just discussed a minute, where the spot was important, because the exchange happens on the spot. Here the exchange does not happen, it is an agreement where the actual exchange of currency is done forwardly. So, but before the actual date of the agreed requirement, that is very, very important. So, it is beneficial in cases of course, times of exchanges when the there is a political instability, when there is the economical instability. Remember the corona days, how it was. Remember there is a recession across, there was a bubble in 2008, then there are many more such instances of recession in the history of world business. So, those were the times when people would certainly prefer. At that time, when of course, in 2008 we had the foreign exchange instruments, but in the past, when the major recession happened after World War, so or at those times forwards were not there, derivatives were not there, derivatives came later. So, but crucial is that the exchange rate is actually to do with the currency, and it is beneficial in cases of fluctuating exchange rate, only then people would like to get into it. Then the next thing is, after this, is the currency swap, the last thing I want to talk about. A currency swap refers to the act of simultaneously buying and selling currencies with different specified value and dates. So, swap, you are the person who deals in this kind of instrument, they are actually dealing with not two currencies at a time, they are dealing with more than two currencies at a time, and they will swapping X currency for Y, Y for Z, and so on. Why I am doing that? Because I am expert, I want to take advantage of the market and my own expertise. So, people with pragmatic understanding and knowledge and and clarity about the working of foreign exchange, because how the price would be affected, very simple question, and this is something I generally would ask any student during the comprehensive viva, or even a professor or assistant professor who comes for interviewing. how the currency prices are decided? A very basic question. It should be coming to your mind too. There are many factors, but fundamentally it's supply and demand rule of economics. So how does demand and supply affects the currency prices? So person who has sense of the demand and supply of a particular currency would be actually playing with these instruments, foreign exchange instrument, be it swap or be it the first one forward we talked about. In swap, person is dealing in more than one currency and having understanding that X currency is now used for this much percentage of the trade in this particular industry or sector, or this much currency is in shortage of supply. It's a demand and supply rule for sure. If something is demanded more, right, and has less supply, it will be priced higher, the price will go up, and vice versa. And if we have a higher supply and less demand, it would be priced lower. So people who are well aware of the foreign trade, export import trade of different countries, different continent, for different industries and sector, have very good clarity on these are the people would be dealing in the foreign exchange instrument, right. So this was the third and the last category, friends. I hope you were able to understand both the types of the financial instrument we discussed. One was financial derivative instrument, second was the foreign exchange instrument. That, as I said earlier, the foreign exchange instrument may not be a separate category in certain literature because they can be taken as a part of derivative, because instruments are based on the underlying asset, which is currency. That is the way to look at as a derivatives, but nevertheless majority of the major will take them as a separate category of financial instrument, and that is what I did too. So with this I would like to wind up, time to sign off. Thank you very much, friends.